Hi, this is Drew Tignanelli, and this is our latest update as to what we think is going on in the markets, and just give you a brief update as to what we're doing. A few weeks ago, you probably saw us start to sell some securities. We took some profit off the table, especially with our commodity exposure and our Asian securities. Why did we do that? Well, both of those security groups were up anywhere from 40 to 100%. And we felt that this market probably had needed to take a breather, let's call it. Which is what you're starting to see. You're seeing some correction, especially in Asia. China right now is down close to 18% from its high. And the U.S. is having some bad days lately. But when we look at the numbers and our indicators, we're not significantly concerned. For one, we're going into a seasonal time of the year when the market tends to be bad. It tends to be choppy. September is the worst time of the year, and it tends to start in mid to late August. So we look at two things that are two big issues that we're looking at: the currency market, the dollar, and how it's reacting in the world currency market, and interest rates, and how are they going up, are they going down? There's a couple other indicators that we're looking at that I can't explain in a lot of detail because most people wouldn't be familiar with it. But there's some other indicators that we use, and none of them are pointing to a significant problem in the markets. Not like last year. Last year we had what was called systemic risk, where the market could literally have lost 70%. Right now, I think you could get a correction. It could be 10%, it could be 20%. But our typical client right now, even our growth clients, is no more than 50% invested in equities, and that's a diverse portfolio around the world of equities. Also, our very conservative clients are probably no more than 30% invested in equities, and most of those are dividend-paying stocks. So right now, we feel very comfortable with where we're at. We've got a lot of buying power if we get optimistic that things are really turning for good. But we're not that optimistic right now. Consumers still very concerned, very pessimistic, not spending the money to really stimulate the economy. But the government is spending a lot of money. The government is borrowing a lot of money, and the government is printing a lot of money. And this is what is helping the market to move forward. So for now, our position is going to be remaining relatively conservative. We'll probably buy China and Asia again on a pullback, which is happening. But for right now, we've pulled our exposure back. We like Japan. I think the market valuations and some things that are going on there, we believe there's a great opportunity in Japan. So that's what we're thinking. Now, what do you do with your 401k? Our thinking is this: if you want to be conservative and you're young or a growth-oriented client, probably 50% in cash, 50% in some form of equity, of which probably half of that equity exposure should be international focused. If you're conservative, you should be back to maybe 70% cash and bonds. And when I say cash, I mean cash and bonds, fixed income of some sort. And if you really just don't want to even worry about what's happening in the market, just go to 100% cash for now and bonds, and don't worry about it, because we have a good equity exposure in our portfolio, so maybe you just don't need a lot of equity exposure in your portfolio. Anyway, that's the gist of what we're thinking. That's why we haven't put an update out lately, is that we just aren't overly concerned right now, but we do believe that it's prudent to be cautious right now. This is Drew Tignanelli saying God bless.